Perfect. So, Christian Mandachescu here is a seasoned fintech executive who has led credit risk strategy and platform development to scale digital lending operations and drive growth across different markets. He is a chief operating officer and chief risk officer at iCreditWorks, one of the leading fintech point of sale lending platforms, before which he was chief risk officer at Scotiabank. He has also been involved with multiple AI initiatives related to credit underwriting and monitoring. So, Mr. Manichescu, obviously that doesn't encapsulate all of what you've done, but feel free to add anything important that you think I missed.
I also taught statistics and finance at Toronto Metropolitan University for 12 years.
Wow. And um when was that?
From 2000 until 2012. Yeah.
And did you straight after that get into Scotiabank or did you like have time
No,
to
I actually was at Scotiabank when I was teaching.
Oh
I
wow.
was teaching part-time first. I was teaching uh, in the regular School of Business, and then I moved to continuing education. So I was teaching at night, and then I was the first one to put my courses online. So I was the first instructor to have courses both in class and online. And then toward the end, I was just having courses online.
So it's just publicly available?
Sorry?
Just publicly available courses online?
Well, not publicly available courses that you had to pay for in order you had to register in them, pay for them, and they were for the university. So yeah.
Very cool. But in terms of the podcast, the goal of this podcast is to help teens, along with other viewers, get a grasp of what finance professionals do. And in today's episode, we'll be diving more into the world of fintech lending, which is what you're specialized in. Its importance and how it works, how it's going to evolve, especially with AI and chatbots growing, and sort of giving teens some guidance in navigating this amazing field. So, without further ado, let's start with some questions. So Mr. Manichescu, what really pulled you into finance and eventually the credit risk area?
Well, I didn't start out thinking that I wanted to work in finance. What drew me in was the puzzle solving aspect. So I've always been fascinated by how money moves through an economy. And early in my career, I realized that credit is at the center of that movement. So credit risk became interesting to me because it blends data, psychology, and economics. It's not just the numbers, it's understanding people, their behavior, and the systems that support financial growth. So that was one aspect of it. The other aspect of it was I like that decisions that I made could directly impact somebody's ability to start something new or move their life forward. And when you're trying to predict human behavior using data, you also have to understand what motivates people, why they borrow, how life events affect their ability to repay, and what builds trust between lenders and borrowers.
So when you decided you wanted to go into finance, did you initially know you wanted to do credit risk lending, or did you have other things in mind?
I had other things in mind. I was just interested in finance per se. I was interested in how money moves and why it moves and so on. And through all these conversations, I ended up understanding more about risk management and what it does. So to me,
I see.
in my career, the turning point that shaped the path toward risk management was when I was asked to help fix a struggling lending portfolio. So that pushed me to understand the whole ecosystem, which is the data, the underwriting, customer behavior, technology, and operations. So that's when I realized that credit risk wasn't what I thought was just a back office function. It was strategic, it was creative, and it was central to any lending business. And that challenge helped me set direction for the rest of my career path. And
So
what I understood as part of that was risk management is never just about eliminating risk. That's impossible. And
yeah.
without risk, there are no rewards. So it's also about understanding it. It's about pricing it correctly and making informed decisions about which risks you're willing to take in a few words, setting your risk appetite. And that is the same philosophy that guided me back then and continues to guide me today. And you can ask, I mean, your father, the risk appetite is what governs the operations of a company, whether that company is a
Yeah.
small fintech startup or it's a large bank.
So, sort of looking back at your early career, I know you kind of touched on this with when you mentioned you had to fix a failing financial portfolio. But looking back at it, what was like a one moment that sort of defined you or gave you a navigating point to a sort of direction for where you could go the rest of your career?
That was the point. That was the point when I looked at that
Oh,
portfolio
okay.
and looked at everything they that brought it together. Because it's not just okay. You're gonna take a few. You're gonna take a book and look at the book. It's not. You have to have the technology to bring it all together, to extract the right attributes, to be able to do the underwriting, to be able to look at the data, clean the data, then through that data to understand the customer behavior. All
Okay.
that is then done to the technology that provides you some background in terms of performance and other things. So uh, that's what made me choose that career path. It was so interesting when you had to bring all of that together.
So if you were, let's say, in my position again, if you were 16 and you wanted to get involved in finance and credit risk lending, what do you wish someone in the industry would explain to you or give you sort of guidance?
I wish someone had told me that finance is way more than just the Wall Street stereotypes, right? It's not just trading or banking, it's technology, it's design, it's psychology, it's problem solving, and it's building real products for real people to use every day. And I'd also want to hear that finance is fundamentally about solving real problems for real people and businesses. Behind every loan application is a person with a dream, a challenge, or an opportunity. And the
Yeah.
human element is what makes all this work meaningful, even when you're deep into spreadsheets and algorithms.
Yes, that's great. I mean, that's honestly what pulls me to finance as well. And this, it's really simple from the outside. I know people think of the Wolf of Wall Street. That's really their entire understanding of finance, but it's a lot deeper, more nuanced, and really has like, the ability to impact real people's lives. So, in
Exactly.
terms of, sorry.
I said exactly.
I mean, so it's sort of more in terms of what you specialize in. How would you explain credit risk to a teenager who's never even take a loan out before?
Well, credit risk is the chance that someone won't pay back you the money they borrowed from you. So if you lend $20 to your friend for lunch with the agreement that they'll pay you back on Friday, right?
Yeah.
Credit risk is asking what is the chance that they will not pay me back and why might that happen, right? So this is credit risk simplified for someone at your age. Uh, when maybe they're unreliable, but maybe they have a tough time. Maybe they had all the intentions to pay you back, but they didn't get their allowance from their parents. Maybe they borrowed from three friends, not just from three other friends, not just from you, and then they don't really have the money to pay all of you back, and then they have to make a decision about who they're going to pay back. Uh, you have to understand all these factors, or
Yeah.
maybe they never had any intention to repay you in the first place. Maybe they do this regularly with a lot of other friends, and maybe that's why they don't have any more friends, right?
Yeah.
And that's how it works.
Yeah. I mean, that would be a terrible position for anyone to be in. But I mean, obviously, as you said, there's many factors in terms of whether you want to give someone a loan or not. But what is the simplest way to describe how a lender sort of constitutes credit risk and decides who gets a loan and who doesn't?
There are two things, two questions that I ask, or everybody asks when they look at a potential borrower. Can you pay it back? Do you have the income, cash flow, or collateral to pay it back? That is called ability. The
Yeah.
other thing is, will you pay it back? So we look at past behavior and financial habits. That is called willingness. So, do you have the ability and the willingness to repay the amount that you're borrowing? Everything else is just different ways of answering these same questions. These two factors form the basics of every lending decision. Then you use technology and data to be able to make the decision faster and more sophisticated by looking at more attributes and so on. But the basic are these two questions.
And obviously, there's like different types of lenders, different types of people taking out loans, and different purposes for it. But how and why do different lenders, such as banks or fintech companies like the one you work at, or credit unions, how do they look at and evaluate risk differently?
Well, I would say, going back to what I said earlier about risk appetite, they all have different risk appetite, right? So banks are conservative and follow strict rules. They have different costs, different philosophies that separate them from fintechs. Fintechs move fast and use more technology and alternative data in order to assess their customer base. And then you also have credit unions that focus on the community and often take a more personal approach. So every one of these stakeholders sees risk through the lens of their mission, right? The key
Yeah,
insight is that risk is not absolute, is it is relative to the lender's strategy, cost structure, and risk appetite for the different types of uncertainties.
okay. Um, so more in terms of what you have done, you mentioned talking about like building a like fixing a finance portfolio and also like building a fintech underwriting system, correct?
Correct.
So when you helped build the system, the fintech underwriting one, what exactly were you trying to accomplish? Like, what was the specific goal of that?
I wanted to build a system that made smarter decisions faster. So we wanted something consistent that was data driven and scalable so the company could grow while still being fair to customers and controlling risks. So we were trying to take the best thinking of experienced underwriters and build it into a technology that works 24/7 and it's always consistent. It doesn't become subjective because if you take the same application, for example, to 12 different underwriters at 12 different banks, you might get maybe not 12 different decisions, but maybe you get 8 different decisions, right? But
Yeah,
a system will always be consistent and give you the same decision for the same borrower, no matter how many times you run it through the system.
yeah. I mean, that's like the power of data-driven tactics and strategies, just using the same data to create more accurate risk management and decisions. But when you were making this platform and developing it, were there any obstacles or difficulties you came across that you didn't really expect that you would have to come across in the beginning or beforehand?
Yeah, so translating human judgment into code, it was much more difficult than I thought it would be, because underwriters consider subtle signals like patterns, inconsistencies,
Yeah,
behavior, different answers to the same question that aren't always captured in the data fields, especially in the data fields that some more conservative institutions are using. When I was at the bank, for example, we were using 19 attributes in order to assess the creditworthiness of an applicant.
yeah.
At iCreateWorks, we use 3,500 attributes, and it
Oh,
takes
wow.
us 250 milliseconds. So figuring out how to respect the nuance of all of this human judgment while still automating the process was one of the biggest challenges.
And in what ways, I know generally like the goal of this was to improve credit risk lending, but in what ways do you think that your technology and the platform you built specifically helped your company make better and faster decisions? Like what specific ways did it do that?
Well, technology allows us to analyze thousands of data points almost instantly. So, as I mentioned, we analyze over 3,500 data points in less than 250 milliseconds. And through that, we spot patterns that humans cannot. And we keep decisions consistent. For a human to look at 3,500 attributes and be able to remember each one of them and then put it all together is almost impossible. But for a machine, that is what we expect of it, and the decisions are consistent. So that reduces bias, speeds up approvals, and helps customers get a decision instantly instead of days, which is how the old way was. So the key is that technology doesn't replace human judgment; it just augments it. And the best systems combine algorithmic precision with human oversight for exceptions and continuous improvement.
So do you think after building this platform, you were sort of relying more on the the technology or more on human judgment, or what was the combination of it?
It's an optimal balance between the human in the loop and the technology that helps that human. And what we do is we look at it over time, so examine performance of the decisions that we've made, and we look at, okay, have we missed anything? What are the attributes of those borrowers that have failed us in some way? Or what are the attributes of the borrowers that have performed better than we were expecting? And then take these and build them back into the underwriting engine, so we have a continuous cycle of improvement that takes advantage of the technology, but also of the human judgment that
Yeah.
looks at the trends that are summarized through technology. And we have AI agents that actually create summaries of all this performance and then build it back into the underwriting engine.
Yeah, that makes sense. So you worked at Scotiabank and also at CreditWorks, which is more focused on lending for like on the dental surgery side. And with your experience at both these institutions, how do you think that banks and fintech lenders coexist? Are there any overlaps or any spaces of competition between them?
So they coexist because they definitely have different roles. So banks provide stability and trust. Fintechs bring speed and innovation. And that's overlap also because you have fintechs that are lending in personal loan and small business, but they often partner with financial institutions because they provide the capital and the regulatory backbone for that process. Uh, and in the beginning, there was competition between fintechs and banks, but that has evolved from pure competition to a more complex coexistence with both that involves both competition and collaboration. As you know, at iCreateWorks, we have a bank
Yeah.
that serves as our sponsor bank that originates our loans. We just facilitate that process through the technology that we have. So there is competition, and because both banks and some fintechs want the most credit-worthy borrowers who are profitable to serve. And then fintechs compete on speed, user experience, and accessibility, while banks, because of their much lower cost of capital, compete on rates, also on established trust and the more comprehensive services. Because most fintechs, they focus just on one vertical. Banks
Yeah.
are very wide in their offerings. They
Yeah.
collaborate because fintechs don't want to become a bank. Becoming a bank, a regulated bank, is expensive and complex, and it takes a lot of money, a lot of people. Fintechs want to be agile, and they want to handle the customer acquisition the way we do, and the technology, with the banks providing the lending licenses and funding. So the bank fintech partnership is the model that is very common nowadays.
No, yeah, that's really interesting, especially because this summer I did some research on buy now, pay later companies, BNPLs, and it was really interesting to see how they're not really competing with banks and sort of like the traditional means of credit, like credit cards, but they're originating their loans from these banks and making them more accessible to general populations. So quite interesting how iCreditWorks takes a similar approach along with other fintechs, but it's more vertical integration into the economy and with the specific sectors. But um, what changes in consumer behavior, especially more recently, have forced lenders like iCreditWorks to sort of evolve their strategy and change how they evaluate um, credit risk?
Well, people expect everything to be digital, instant, and transparent, right? They compare products online. They don't want to fill out paper forms and wait weeks for decisions or wait in line in a branch, right? Hey,
Yeah,
when was the last time you went to a branch?
I had no idea.
You've never been to a branch. So lenders have to modernize, have to provide cleaner interfaces, faster underwriting, and more flexible products. And everyone nowadays expects to be able to have access to these financial products through their phone, to their
Yeah.
mobile device that's with them 24/7, right? And that is the change in consumer behavior that benefits fintechs and forces banks to actually ally with the partner with fintechs in order to be able to offer that kind of experience.
I know because like consumer behaviors and how consumers do lending is evolving, same with lenders, but obviously there's regulations in place. How do these regulators shape what lenders can and can't do? So where's like the line drawn in terms of like how you evaluate risk and how do they determine that?
So regulators set guardrails, what data you can use, how you treat your customers, how transparent pricing must be, how you handle risk, right? Their
Yeah.
goal is to keep the system fair and safe. Lenders innovate within those boundaries, right? You can't just move ahead of them because then the system becomes unstable. So regulators must balance encouraging innovation, which is fintech's new products, with protecting customers from potential harm. So you have to move fast, but not faster than you can actually be able to handle
Yeah.
business in a well, mitigate the risk for that, and through that you expand the you actually expand the market successfully.
Okay, so more specifically, like to individual customers, when you're looking at a loan file, what is the first thing you're looking at? What is the first thing that catches your eye in this whole evaluation process?
Well, I look at the story that the data tells. As I mentioned, we get a lot of data. So, and I look at that. And if someone doesn't have the income to service the loan, nothing else matters. After that, I look at behavior. How have they managed obligations in the past? So it goes back to, okay, do they have the ability to repay and do they have the willingness to repay? And then I look at everything else that's part of the application, which is, does the stated income make sense for their stated occupation? So if I'm a barber and I say that I make $250,000 a year, what kind of barber am I?
Yeah.
Is the loan amount reasonable relative to the stated purpose? So if I want to buy a car and I'm asking for $150,000, really? Are there any recent credit inquiries suggesting that the applicant is desperately seeking credit everywhere else? Are there any gaps in their credit history? Things like that. But again, if the math doesn't work up front, nothing else matters. The loan will likely fail.
Yeah. So, I mean, obviously data is supposed to show you the whole picture, but also looking at their behavior and looking for any mismatches in the pattern or what the story's telling you. So, in terms of like not only the companies you've worked at, but also other companies, other fintech lenders, what is a mistake you see a lot of these companies make in terms of lending and credit risk?
I see that the mistake that they're making is either they trust their models too much and they rely on models too much, or they're humans too much and they rely on those humans, because good risk management is a balance. And the models provide consistency, but humans understand context better than models. So you need
Yeah.
both. And companies build sophisticated algorithms. They see them perform well in testing, and then they put them in production, and they assume that they've solved it. But the market changes. You have a crisis like in 2008, consumer behavior shifts, or you launch a new product or a new vertical or in a new market, and everything changes. So you have to continuously look at that optimal balance between human interaction and model augmentation.
Yeah. So, I mean, kind of going back to the whole idea of finding the perfect balance between how much are you relying on the data and the algorithms you're developing, but also just human judgment. Is this adding up or whatever? So, how much, that being said, how much of the algorithm and how much of the credit risk is just math and modeling compared to judgment and experience, specifically in what you have done? Because I know you're saying it's a balance, but where do you see yourself relying more on code and math and algorithms? But where specifically are you seeing yourself being like, oh, my gut feeling is telling me this, or my judgment is telling me this?
So early in your career, you probably use 80% math and 20% judgment. Later, it flips. So the models tell you the what, experience tells you the why. So in our company, the analysts, it's 80% math, 20% judgment. At my level, when decisions come to my level, it's 80% judgment, 20% math. And the best risk managers combine quantitative rigor with qualitative wisdom. They trust the math, but they verify it. They use the models, but they understand their limitations. And they know that behind every data point is a human being in the end whose life circumstances matter.
I mean, this is kind of interesting and funny at the same time, but I've talked with some um like investors in the stock market and specifically day traders, and they tell me a really similar thing that in the beginning you sort of rely more on the algorithms you're developing or whatever forecasts and predictions and all the models you create, but over time you kind of learn and have the ability to focus more on your judgment, where the math and the models form a basis and a starting point, but most of it just like how do I use this model and how can I apply this to make the best decision. So a lot of it at the higher level is about judgment. I totally agree with that. So bigger picture, lending kind of keeps the whole economy turning. You mentioned that at the beginning. It's probably the core or one of the key components of the flow of money in the economy and is really critical in many areas, from any startup, whether it's like buying homes and cars to medical or dental operations with what you're working with. So all over the economy, we see vertical integrations of different forms of lending to different types of consumers, different types of people receiving these loans. What do you think in a economy so complicated of lending, what do you wish teens understood more about that they don't understand in the status quo?
Well, I think you summarized it in the question. Everything big in the economy runs on lending. Businesses starting, people buying homes, students going to college, doctors opening clinics. Lending is essentially the fuel for progress.
Yeah.
Without it, economic growth would slow to a crawl. When the financial markets are closed, nothing happens.
Yeah, I mean, again, we're just reiterating that it makes a lot of sense. It's super important the work that you do and how, especially in your specific sector, making loans for people getting dental surgeries and operations more accessible. Other lenders, they have different focuses, but at the end of the day, it's just to make sure when people need certain amounts of money for whatever purposes, they're able to get it, they pay it back. It just really keeps a lot of the functionality of what we do in our economy up and running. So, um, I mean, we kind of already talked about this, but there's a lot that teens don't know. But is there any misconceptions, anything that teens or a lot of young people think about lending, think about the economy that's actually not true that you want to clear up?
Well, I think that the biggest misconception is that it's all about money, when actually it's about solving problems and creating opportunities. Good lending helps people build their lives, not trap them in debt. Another misconception is that finance is about being good at math. And yes, math helps, but finance is fundamentally about understanding people, solving problems, and making decisions under uncertainty. And probably the best finance professionals that I know are curious about human behavior, and they are skilled at asking the right questions, good at storytelling the data, and comfortable with ambiguity. They're
Yeah.
often people with double major in psychology and economics, people who study philosophy and then learn statistics, or who worked in customer service before going to business school. And if you think that, oh, I'm not a math person, finance is not for me, you're wrong. If you're interested in understanding why people make the financial decisions they do, how to solve problems with limited information, or how to design systems that work better for more people, finance might be perfect for you.
This is this is great because even like in terms of AI and how the world is evolving, there's a lot of debates on the humanities side. So really any sort of transition, how people can enter finance. But that being said, again, with a lot of consumer behavior changing because of AI, a lot of how we do things and work in the economy changing with it, how do you foresee fintech lending to change specifically because of AI in the next coming, 10 years?
So let me just talk about a misconception about AI. There is a lot of talk about AI replacing us, uh, and that is completely untrue. AI is not going to replace me, is not going to replace you. People who know how to work with AI will replace us. So it's going to be more of a symbiotic relationship between humans and AI. And that's what is going to transform underwriting from backward looking, where we just looked at points of data that we had in the past, to forward looking, where we're using that data points and we're using AI to augment our own judgment and predict future behavior based on that. So the
Yeah.
more attributes you add to that, the better you are able to predict future behavior. And before it was just a summary of what you've done and your credit score. But AI will make credit decisions increasingly real time and personalized. And it's not going to be one size fits all like the banks
Yeah.
used to be in the past. You had to be in a box, and if you didn't fit in that box, you wouldn't get a loan. It's going to be risk will be assessed in real time based on your real financial behavior, based on exactly what you posted on your Instagram that moment. If that data becomes available, the decision is going to be made on that.
Okay. So sort of like coming to a close now. I think we've had really great discussions about your field, fintech lending, and its importance. But as like for example, as for me as a teen and the other viewers being teens, what skill would you recommend for us to start building right now if we're curious about, really making it out in finance and fintech lending?
Well, I would say first data literacy, understand how to interpret and question numbers. I would also recommend basic coding. Even a little gives you a huge edge in fintech. If you and it's so easy to learn coding. And although people say that yeah, you can use it through AI, if you understand the basics of coding, you'll
Yeah.
understand how AI operates, and you'll be able to use it even better. Then communication. The best people in finance can explain complex topics simply, and not just in finance, everywhere. If you're able to do that, you'll do well. And curiosity. You have to continuously learn. If you stop learning, you're going to stop doing. And critical thinking and skepticism. Finance is full of people confidently claiming they know what will happen. No,
Yeah.
you got to ask the questions. How do you know that? What evidence supports this? So you have to be comfortable with data and basic statistics. You don't need to be a mathematician, but you need to understand concepts like probability, correlation, and to be able to assess whether the evidence that you're being presented with is real or is reliable or not.
Yeah.
But some of the most important things is understanding human psychology. Just understand what people do with money and why they do it.
Yeah.
And to me, that is very important.
So, I mean, that's a lot of great advice for me and other people as well. It gives a lot of clarity. But looking more specifically back on your journey, what do you think you did best? And what do you think that you've like learned really importantly that you can share with other teens about your experiences and your journey?
So I stayed curious and adaptable. And I also built genuine relationships with people across the organization and other organizations, which created opportunities and made the work more meaningful. I also moved across geographies. So I worked in countries. I traveled to probably about 36 countries for Scotiabank when I was there.
Oh, wow.
And I I was not afraid of starting from zero. I moved from department to department, and I challenged myself to learn, but also to build connections with people there, because you grow a lot by saying yes to a new problem and
Yeah.
staying curious and working with people who challenge you to be better. And from that perspective, soft skills matter more than you think. So technical abilities get you hired, but communication, collaboration, emotional intelligence, and resilience determine how far you go. So invest in these. The other thing is setbacks are just points of data in time. They're not failure. I made mistakes. I worked on failed projects and faced rejections, but I have learned from every one of them. So you have to learn to struggle well. When you
Yeah.
struggle, you need to move forward and struggle well. And the final thing is find work that matters to you. You
Mhm.
spend enormous time working. Choose problems you care about solving and organizations whose values align with yours. Money matters, but meaning matters more to long term satisfaction.
Wow, that was really inspiring. I mean, thank you. Thank you for all this amazing advice,
My
this
pleasure.
amazing guidance, and giving a lot of us clarity on finance and your field. And I think it's going to be helpful for me along with tons and tons of other teens. So really appreciate everything.
Well, thank you for the opportunity to chat with you.
Perfect. Thank you.